gold has been a great, protection against, the devaluation of currency and bonds. If you look at history, it's got anywhere between a 1 to 2% annual growth rate in terms of estimated supply growth per year. It's extremely stable. It's very, very hard to produce more gold quickly, even when the gold price spikes. And so you have this very stable kind of hard money currency. If you look at domestic U.S. oil production, it peaked in 1970, and it then went structurally down for decades. We basically just ran out of, the ability to keep expanding conventional oil at that pace. So we're obviously still producing it, but we were producing it less, even though our demand was still growing. And so we had to shift towards more imports. And that, of course, when you're also going off the gold standard, we had a variety, basically an inflationary environment for those monetary reasons combined with those physical restraints connected to energy and other things. And so I would describe the 70s as a lot more specific compared to the closer analogy with the 2020s and the 1940s. But there are elements from the 70s as well. I mean, we have similar fiscal programs, and I think we're arguably going to have some energy shortages. What I do find the 60s particularly useful for is that it's a closer comparison to in equity market terms than the 40s were. Yeah. Because the 40s, we went into that decade with very low equity valuations. We obviously had the whole, the Great Depression. Then even in the initial phase of the war, up until the, some of the early decisive victories in the Pacific, equities were very pessimistic. So they went into that period with low valuations, and so that's not necessarily a good, framework for determining equity performance in this environment, because you had very different starting valuations. Whereas the 70s or the late 60s, you had the Nifty 50 stocks. And so you had these, large cap U.S. growth companies that could do no wrong, that were very highly valued, combined with the fact that we were running into a more inflationary environment from a very, disinflationary low rate environment. And so you end up getting a decade of poor returns, even though many of those companies, those companies were like Disney, Coca-Cola, Xerox. They did incredible for decades fundamentally, but they were just mispriced in the late 60s. And so I actually do think that the 60s and 70s are, of course, still very illustrative to us, and especially in terms of say the equity market. Overall, I find that that kind of long-term debt cycle, the 40s, is kind of, I think, for me, kind of the biggest kind of framework for thinking about it. And then what I do is I go to these other periods and I find those similarities. So the 60s, like we said, as the equity comparison and the energy comparison. Another analog you can use that, for example, Luke Groban uses is Europe in the 20s, 30s, and 40s, because back then the United States was in some ways like the emerging market. We were the rising power, and so we were the creditor nation. We were the exporter. And some of those had their industrial bases damaged from the war. The UK had trade deficits, and so he uses some of the more European analogs for determining where we are in the cycle. And I think there's a lot of validity to that. And so I basically kind of go through these kind of one by one and kind of put a patchwork together to come up with the closest thing. Another thing is, in terms of say hypothetically how TIPS would do or how short-term treasuries would do in general, a big difference between the 40s and the 70s is if you parked your money in those shorter-term treasuries, you could retain at least somewhat more of your purchasing power than you could in the 40s, because in the 70s those short-term rates would eventually adjust to kind of keep up with inflation as the Fed tried to fight it, whereas in the 40s, because they completely gave up from the start on fighting that inflation, and instead capped the yield curve, those short-term ones actually did even worse than the long-term ones. And so really kind of there's nuances like that are helpful to know when navigating this. So in the 70s, shorter-term bonds could protect you more than longer-term bonds, because as yields went up, you could roll your shorter-term bonds into newer issues with higher yields. You still didn't do great, but you did okay. Whereas in the 40s, the ironic thing was that even though you had inflation, longer-term bonds did better because the whole yield curve was capped. And so basically, if you were holding a 10-year, you were getting like 2.5% yield, and you just kind of holding that for the decade pretty much. It wasn't going any higher, and you were getting inflated away, but you were still earning 2.5%. Whereas if you were holding T-bills, you were getting paid less than 0.5%, and still getting that inflation. And so actually you had a weird thing. If you look at the central bank balance sheet because in order to do yield curve control, they had to buy a lot of bonds. They basically had to have an open bid in order to buy bonds to defend their peg. And what you saw is in the early phase, they bought a lot of long duration. But then as this went on and the market saw that the Fed's yield curve control was credible, they started to say, well, wait, I mean, if we have an artificial positive yield curve just pegged here, then I'd rather just hold the long-term stuff and at least get a small yield. And so the Fed actually had to twist this entire balance sheet because nobody wanted the T-bills. Everyone wanted the longer-term stuff. And so the Fed had to change their structure, basically do an operation twist, but in reverse, to accommodate that shifting demand. Most portfolios are structured with the idea of the past, 20, 30, 40 years of structural disinflation from a high inflation level, which is very good for the 60-40 portfolio, and that inverse correlation. And so everyone's kind of positioned to fight the last battle. And so I think that's not a great portfolio going forward. And so yeah, I structurally agree that I generally want things other than bonds, with the caveat being that if you can have some cash or T-bills or bonds for dry powder, if for whatever reason you have a view that equity markets are going to perform poorly over a specific time frame, and you can kind of rebalance into that. But that overall, the more you hold in those bonds and cash longer term, you're locking in a nearly guaranteed, flat to negative return, real return. If we were to go back in history before Bitcoin existed, gold would be the go-to for this. It's kind of an alternative currency. It's got, if you look at history, it's got anywhere between a 1 to 2% annual growth rate in terms of estimated supply growth per year. It's extremely stable. It's very, very hard to produce more gold quickly, even when the gold price spikes. And so you have this very stable kind of hard money currency. And there's not a lot of demand for that in an environment of stable monetary policy where you have positive real yields, because there's an opportunity cost for holding this zero yielding asset. But when you're in an environment of inflation, and then specifically inflation that's higher than the interest rates, then suddenly a zero yielding asset looks a lot better than a negative yielding asset that they're printing a lot more of. And so that's why, for example, look at the 80s. Inflation was still high, but gold did poorly because by that point, yields were above inflation. And so there was a case, Volcker had addressed the negative yield concern. And so, after gold had that bubble, a lot of capital wanted to get back into treasuries because you actually had a positive real return now. And so gold has been a great, protection against, the devaluation of currency and bonds. But of course, now with the invention of Bitcoin, we have this other asset that we can explore, and that is, taken arguably market share and also just thought share and basically mind share from gold.